Welcome. I'm Lisa Arthur, U.S. Managing Director of Sensedia. Thanks for joining Sensedia Talks. Welcome to our webinar. We're recording on February 13th, 2025. And we've recorded it because this expert panel is like you these days. We're juggling busy agendas, fast-changing financial landscape. So we recorded it so we could capture each of these thought leaders. The truth is, the world is changing faster than ever, and it feels like we're all trying to keep up with never-ending headlines and changes. But let's be real. A couple of topics we're covering today might be yesterday's news by the time you watch this. But here's the thing. No matter how fast or much the government and regulatory landscape shift, we'll focus today on some fundamental concepts that remain constant, like the need for credit unions to innovate and adapt to thrive. Joining me today are four professionals who bring a variety and deep experience in the credit union space. We're welcoming Raj Bandaru, CIO of Connecta Credit Union, Bill Butler, CEO of Kachinga, Susan Mitchell, CEO of Mitchell Stankovic and Associates, and our own Felipe Torquedo, Head of Solutions for the US. Today, this expert panel and I are going to talk about fintech integration and its role in expanding credit union reach through elevated member experiences. Before we meet our awesome guests, here's just a couple of insights and key takeaways we aim to leave you with. We're going to talk about how credit unions are overcoming partnership challenges and navigating the complexity of the fintech landscape. We'll explore next generation member strategies that attract digital natives and their families. We'll also discuss a common challenge many credit unions face: technology. And we'll learn about a game-changing credit union shared service, CUSS, and how this new model unlocks significant member growth potential. But first, let's meet our panel. Raj Bandaru, CIO of Connecta Federal Credit Union. Raj, it's my pleasure to welcome you and the expertise you bring. For our audience, Raj oversees IT, payment systems, and digital delivery, drawing on many global leadership years at JP Morgan Chase and transformative roles at Giza Credit Union in my backyard here in Washington State. With advanced degrees in engineering, computer science, and management, coupled with his vast industry knowledge and leadership experience, Raj is an expert at guiding credit unions through complex technical challenges, and he's going to help guide us all today. Raj, welcome. It's great to have you here.
Thank you, Lisa. Couldn't have done a better job myself.
Well, we can't wait to hear you, so thank you again. And next, but not least, is Bill Butler, CEO of Kachinga. We're welcoming Bill back to Sensedia Talks. He's been a featured guest before because his leading financial technology company is dedicated to bringing the next-gen banking to credit unions across the country. With over 20 years in financial services and technology, Bill has led various organizations, including Experian and ADP, where he drove innovation, partnerships, and growth. His experience spans the entire financial ecosystem, from fintech to credit unions, making him a unique expert on our panel today to cover both topics. Bill, welcome back.
Yeah, thanks, Lisa. It's great to be here with a great group of folks.
We can't wait to hear more from you and what you're seeing in this credit union market. Next, I'd like to introduce Susan Mitchell, the CEO of Mitchell Stankovic and Associates. We're thrilled to also welcome Susan back. She's a respected leader in the entire world around credit unions, experience with advising, growth strategies, boards, and the C-level. And that's global, not just here in the US. So she brings this global perspective and innovative insights with lots of experience with credit unions. She also takes a very forward-looking and I'll say provocative approach as she helps credit union leadership founding the underground, which is a big event that enables credit union executives to talk about real issues and solve real things. And she's spearheading the credit union shared service model, CUSS. Sue, welcome back. It's great to have you again.
Hi, y'all. It's great to see everybody. And thank you very much for my global presence. That was very nice. Thank you.
Well, I know our audience loves to look outside other credit unions and what they're doing. So we're excited to hear from you.
Thank you.
And wrapping up our panel of experts is Sensedia's own Felipe Torqueto, head of solutions here. Felipe has spent 10 years of experience with financial institutions addressing their legacy infrastructure and integration challenges. He'll also help us today understand what there are in solutions and offerings and what credit unions and fintechs can do to work better together. We're excited to tap into his technical knowledge. I expect Raj and Felipe to have some really insightful conversations as we look to help all of you modernize your technology in a way you can. Torqueto, thank you for being here.
Thank you, Lisa, and thank for everybody watching.
Excellent. And one bit of advice, or actually a huge favor, I'll ask all the panelists for. Let's be candid. Let's be transparent. Let's shake it up. Let's talk about the real issues and be authentic. I know each of you, and I know we can count on that. So let's go ahead and jump in. And I'm going to jump in and lead with a fact. And this fact actually comes to us by way of Sue's organization, Mitchell Stankovic. And in fact, this fact is last September, NCUA board chairman Todd Harper said, and I quote, "The latest quarterly performance data for the industry showed declining growth and weakening performance across auto lending, mortgage loans, and commercial loan categories. These trends are contributing to the large percentage of credit unions with CAMEL's composite ratings of 3, 4, or 5. In fact, approximately 1 in 5 federally insured credit union have CAMEL's code rating of 3, 4, or 5. And you can find this in the CUSS white paper that we'll make sure you have a link to download after this webinar. But keeping that stat in mind, Sue, I want to begin with you. First of all, for our non-credit union audience, can you explain what the CAMEL's code rating is? And then for all of our audience, how does this stat reflect the status of the credit union industry today?
Thank you, Lisa. And the first thing I'll say is that they can also find it on NCUA's website because it was the report for fourth quarter. We also have to look at it from the standpoint that when we hear these numbers, understand that the rating system is based upon NCUA, National Credit Union Administration exam of credit unions. And quite often, because of different sizes of organizations, those numbers can be misconstrued. So we have a strong, healthy credit union movement at the moment. And I just want to make sure that everybody understands that we've gone through some adjustments, just like the world has economically. So let's start with what does the CAMEL rating stand for? When a credit union does an exam, they go in and they look at a myriad of things, and they're looking for capital adequacy. So that's our C. They want to make sure that credit unions can weather a storm with, for our non-financial people, with their savings. So capital is really the net worth, the savings of the organization. Then they look at asset quality, or A. Asset quality means, do we have a loan portfolio, or do we have investments that potentially aren't to the level that they need to be? So we want to make sure that we're constantly looking at not only our net worth and our capital, but we also want to say, hey, what's the chance of it shifting because of asset quality? Then management is key. That's our M. This is looking at the overall management, understanding what their plan is, them understanding where the credit union is, and making sure that they have proper what-if scenarios, disaster recovery, some of the things that we know are needed in today's environment. Earnings, that's all about the bottom line. So as much as a credit union is a not-for-profit, we as industry leaders understand that we have to be able to cover our costs. Technology is expensive. Growth is expensive. The things that go into serving and social impact, we want to give that money back. So we're looking at earnings from the standpoint of, in a way, you have to make money to give it away. And that's credit union's model. It's all about the mission. It's all about giving back. Liquidity means we got to be able to have the cash on hand. And that's very similar to a consumer. It's not just all tied up in investments or it's all tied up in the lending portfolio. We need to make sure that we have some liquidity to be able to invest, do the things we need to do for our members and make up the difference if there's earnings. And then the final thing is sensitivity, S. What we're looking at on sensitivity is the whole idea of how sensitive is your credit union to economic changes, to environmental changes. And this has become more important as we've looked at new accounting rules and things that have impacted the credit union space. And so we're constantly saying, how sensitive are we to that? Recently, I'll wrap up with things like the fires that just hit Southern California, the weather and the storms that hit North Carolina and the East Coast. All of those things require our members to have to adjust. And so as a credit union and the leadership and the management, and then NCUA is protecting the National Credit Union Share Insurance Fund and ensuring that all of these factors are in place. Does that help?
It's very helpful. Thank you for walking all of us through that. And I'd love to ask you and Raj a follow-up question if I can.
Sure.
Given where credit unions are and that we've got a healthy movement, but there's some maybe signals of needing to focus on remediation, what do you see as countermeasures that credit unions can take to not only stop, but improve their auto, their mortgage, their commercial loans, the rest of their portfolio for their members?
Raj, why don't you
I can,
start?
yeah, sure. So Lisa, so there are two sides to this equation, right? So for the credit union to be healthy, you have the growth side and then you have the expense side. So of course, on the growth side, whatever has happened or transpired over the last several years, you'll see a lot of credit unions, and because of the interest rate environment, the way that it's gone up so fast and not coming down fast enough, you'll see some lopsided balance sheets. Right, so a lot of credit unions are dealing with that, and of course, with the pandemic and post-pandemic influence, the lending has come down. I mean, people, a lot of members and people do not have as much liquidity as they had during the pandemic when you had the government stimulus. So the deposits are drying up. People are not taking loans as much as they did in the past. It's slower, right? So they're not refinancing their mortgages anymore. Why would they when they're at a low interest rate? So there are several economic factors that are driving member behaviors on the lending side and on the deposit side. Having said that, from a growth standpoint, credit unions have to start thinking about more creative ways to raise deposits, to get new memberships and grow in lending portfolios. What that would entail is, come up with creative products to generate deposits, right? If you look at banking products, majority of them are all pretty much commodities. So what differentiates one credit union or one bank from another? You have to come up with creative products that have some value adds for the members. So that's how you generate deposits and members. And on the lending side, we may have to reposition some of the lending products with better feature functionality rates, and maybe venture into areas that credit unions normally do not. Maybe small business lending could be one, right? You have get creative with some lending products. Like we did at Connecta, we came up with a mortgage product called Meet Me in the Middle, which is a pretty creative lending product considering the high interest rates and people not trying to refinance or buy a new property because they're stuck in a low rate mortgage. So you can get creative. And at Connecta, we also launched a new deposit product with a whole slew of benefits for the members, like roadside assistance, cell phone insurance, you name it. We've got about 15 or 20 different functions or features that you can avail a teledoc, without any down payment for a doctor visit. All of that if you have a checking account. So you have to get creative. That's on the growth side. And on the expense side, of course, cost cutting. And then we truly need to focus on automation and efficiencies across all workflows, across all departments, and across all back office. So that's on the expense side. So you got to tackle both ends and become efficient and flip the balance sheet around.
Yeah,
Oh, go ahead, Sue.
I was just going to say, and the only thing I would add, because he covered it so well, is we have to remember we're credit unions. And when we put the products and services together, understand the market. So creativity can come from social impact. It can come from investing in the communities. It can come in ways that would further our mission and differentiate us within the market. So when we talk about, the balance sheet and the size of the balance sheet, we're also juggling how do we make a difference on the bottom line. And so Raj covered the basics. I actually went into a lot of detail. Thanks for the best practices. I think that's fabulous. But I would just suggest to everyone, do it around mission. Do it around what would differentiate you within the market, because literally people will talk. That will add to member growth, and that will add to the grassroots growth.
Yeah.
I think all of that is great advice. I want to zero in on one thing, Raj, you said, and I think it's really important, and I've heard this, that many credit unions are looking at partnerships or the ecosystem and really only considering fintech. When you went through Connecta's creative offers, I heard a lot of local and more not just fintech partnerships. Could you speak a little bit to that?
Yeah, so I would call it's both, right? You're leveraging fintech partnerships to deliver for your memberships and to deliver for your local communities, right? So you're catering to your membership base, your seg base, your local communities, but you're using a fintech to do it, or a myriad of fintechs to do it.
Yes, well said. And one thing that I like, and it sounds like the Connecta brand has done a good job of that, it's meeting the member where they are, and having those products and services. With that, another trend that's going on in this industry is consolidation. And I'm curious to all three of our panelists, what are ways that our credit unions and the movement can preserve their community ethos while maybe there is a need to consolidate with another credit union to keep the movement strong? What are your takes on that?
Bill, you?
Yeah, I'll jump in. Community has always been at the center and heart of the credit union. I think we heard that theme both from Sue and Raj in their responses. With small to mid-sized credit unions in particular, that's even more important, right? But questions come up that are concerns from those in the space, right? How do we handle the current cost for tech while budgeting for the latest that we need to succeed? And then another question is, how do we add and attract new members, sometimes with little to no budget to do so, right? And so those are real challenges. They go back to the balanced budget, right? It's the constant grind I think that all of us are facing. But there are answers to that, right? And I think a lot of it's been solved over the years through the acceptance of CUSOs, right? Through adding technology to the mix, helping credit unions really compete in the market. But there are other ways too, right? We've talked a little bit and hinted about a shared model. There's really great ways to stay to the grassroots and to really encourage community. And then Sue mentioned it as well. I mean, there's always a way to get back and encourage members to get involved, participate, give back themselves, or maybe even those that receive the support to join in and participate with the member, right? So again, there's really creative ways, I'd say, still for the credit union industry to retain that sense of community, even with the pressures to consolidate or to cut tremendous costs, right? There's definitely creative ways to look forward and upward.
So I'm going to jump in because then Raj will have a response for me on this. I think we have to get shit done, and I'm going to talk about that periodically. We do a lot of talking around consolidation. The key for me, as you know, has to do with thinking forward and figuring it out. It's not an easy solution. And when we have the diversity that we have of credit union asset size, when we have 500 credit unions of the 5,000 or just under 5,000 are, big, and the rest are, if you would, from a banking financial ecosystem, small. And so we know that we have to change the model. We know we have to break away from some of these legacy practices, not just technology. And so Raj mentioned a key component of that, and I think we haven't spoken to it enough, and that's that consumers are vulnerable right now because of legacy technology. So the kind of investments that Raj has made in their organization is required, and our small credit unions have to be able to do that too. We can't exist in a world of lack of people resources and lack of technology resources based upon price.
Yeah. No, great point, Sue. Great conversations from both Bill and Sue. What I want to add is, credit unions, so smaller credit unions over time, like Sue said, will have a hard time surviving, right? So you will see mergers. So the good news is most of the time you see credit unions merging with credit unions. So you are maintaining that credit union ethos for the most part, right? So member is always at the center of every conversation or any product and service and rates and fees, all of that. The member is always the focal point. Having said that, you're also seeing a trend of some credit unions acquiring smaller community banks. So in that case, I would think, when a community bank gets merged with a credit union, they're actually getting a better service, right?
I would agree with that.
Right? So there's a positive there. So from a consolidation standpoint, I think the credit unions sort of have a leg up, right? When it's, when it comes to a member experience standpoint. But with consolidations, of course, comes the complexity of merging systems. Right? So in most cases, you end up merging legacy systems, right? And then you're making technology decisions across the tech stack on merging these two institutions together. Sometimes merging does not even make sense if it's a tiny little credit union, because the amount of time and money you spend in merging is probably not even worth it, because you can, generate the same revenue in a month organically. So there are a lot of decision points that go into it. But again, the consolidation is happening. There is technology complexity. But the good news is the only way forward is partnering with fintechs, partnering with solution providers, so that you can provide the best and latest and the greatest and the best technology and member experience while retaining that community focus and localization and personalization. All of that has to, go hand in hand.
So I hear Raj, you saying something important, and I think Sue, you and Bill are also saying it, which is a need to zoom out and really assess kind of everything that's going on, and not just take it for granted that if there is going to be consolidation, that everything merges. It's a chance maybe to have a fresh start or a fresh tech stack. And I know we'll talk about the CUSS model a little bit later, but I think that comes into this as
Yeah.
well.
Well, and there's a couple of just complexity issues that are brought up here. We're dealing with, let's say, a bank. We buy a commercial bank that buys that product that Raj was
Mhm.
talking about, right? It also makes our tax exemption, okay, vulnerable. So we're constantly doing this little dance, if you will, of being able to compete, stay in the market, and understand what the future is. Another complexity is, how do we afford the talent that it takes to have that complexity at the chief executive level? So the things we're talking about here are not easy solutions, right? So consolidation is going to happen. It's going to be diversified, but it also could be a consolidation from a collaborative standpoint.
Mhm.
So I just wanted to reinforce that it's not easy. And people want to throw out solutions, or they want to throw out criticisms. And I think we have to really work together and have the best idea of how we make it happen.
I think those are excellent points, Sue. Thank you. Want to talk a little bit about, we've talked about fintechs, the creative offers and products that our credit unions can offer because of innovating with fintech. And there's been some research this year from Cornerstone Advisors that says credit unions' top challenge in improving technology efficiency, taking some of those costs out, as we've heard from Raj,
Mhm.
are a lack of integration between systems, these legacy systems, and new technologies and applications. And this Cornerstone report also says that on the average, credit union executives believe they could realize nearly 1.3 million from improving technology efficiency through consolidating some of their internal things, and getting better integrations. And Raj, you said it, automating like technology workflows. I'd like to quickly have Felipe Torqueto talk a little bit about modern integration strategies in technology. You've been in technology deeply for the last decade, Torqueto. How are new technologies helping reduce the costs and actually remove the friction for credit unions?
Well, um, first and foremost, right, modern integration. So it's not exactly what an end user is looking for, right? So yes, C-levels and everybody else inside have a very big job integrating those systems because they know the importance. Although for the end user perspective, right? I'm an end user and I want what? I want next gen banking, for example. But in Raj position, for example, Raj is okay, everybody wants next-gen banking, but I do have legacy. I do have many fintechs to integrate with. I have many partners. I have legacy core banks. I have a lot of things to deal with. First and foremost, um, analyzing the integrations that we have in-house today. Is that enough? And normally the answer is no, because nobody's doing integrations in a way that, okay, I need to focus in integration and automation itself before, and then the big features, the big stuff that I'm going to deliver to my end user will come naturally, right? So this is the most important part, which is acknowledge the problem with integration, right? Because Lisa, me and you, we were talking to credit unions and they are saying to us, yes, I love fintechs. I love what they deliver to me, the value. And also for the community, I love everything, the value that they are delivering, although integrating with is a nightmare, right? It's costly. So first
Mhm.
and foremost, acknowledgement. The second part is integration in legacy is not necessarily a bad thing. So legacy brings the credit union and the community where they are today, and they are not small, right? Like Susan mentioned, they are big. We have a very huge community of credit union, and the systems and everything that they had brought them here. The point is, today we need to leverage next gen technology and keep in mind that the next generation integration needs to have focus on legacy as well, leveraging what you have inside, and then enhance it for the end user, for the member, which is the most important part. So the strategy itself, it's legacy friendly. And remember, it's legacy friendly, right? We're going to integrate with legacy as well, leveraging the new, enabling the credit unions, and enabling ecosystems. The key word is ecosystems, always enabling the ecosystems for the balance sheet, like Raj said, how fast a credit union can deliver. With a solid integration strategy, they can be creative faster. This is the most important part. So for me, those layers add up to the modern integration. Do not forget legacy. Yes, they are important, although we need to leverage the new as well. With that, I think we have a balance between spending over allowing and enabling the credit unions to create this ecosystem.
Thank you. Raj, Sue, Bill, what do you guys think?
Yeah, so I can talk about some of the, at the highest level, Torquato hit it on the nail, right? So everybody relies on the core systems. That's your central focus area, right? Your core system most likely is a legacy platform. But guess what? That's the brains of your operation. And the core systems will not innovate or progress as fast as what the members want. Impossible, right? The core systems are going to be, slow and steady. Even getting out of that legacy mode is going to take them a decade or more. I'll probably be gone by then, right? Having said that, the way the institutions are innovating they're putting all these fintechs and the latest and greatest software products around the core system. So all these fintech products, let's use. I can rattle off our Connecta online banking platform has about 40 integrations, right? All these integrations are providing some experience to the member or some functionality to the member, and they're all integrated to your legacy core platform through some middleware integration or some integration of some sort. Even the integrations are all over the place, and that adds complexity. Some are SSO integrations, some are API integrations. The look and feel of all of these integrations are different. Sometimes there's no consistency in how they interact with each other, and that ends up confusing the members. As the end user, you want an uniform, consistent look and feel and experience. But when you create a myriad of integrations with different third-party fintechs, guess what? It's very hard to create that consistency and common look and feel and customer experience. It's almost near impossible to do that. So those are some high-level, big-ticket items or challenges that we need to address as part of addressing this legacy consolidation and all the fintech integrations.
Yeah, and I'll just add real quickly and push it over to Bill. And we have to be careful that we're not adding legacy to legacy. In other words, if we're extending this mess, if you will, that we have with antiquated legacy systems, and we're extending into additional hard, stacks. Now we're in a position where it's the unbundling of it becomes even more important. So, when Raj made the comment that there's the potential for sidecars, and Torquato, when you talked about, looking at it in a different way, but I think you called it legacy friendly. I look at that and I say to myself, okay, but we got to have a roadmap so we don't get ourselves into this same thing for 50 more years.
Yeah.
So my thought, Bill.
Yeah, the only other thing I'll comment on is we're actually at a pretty exciting juncture, right? We've got access to a lot of great new products in the market. With Connecta's example of, tens and dozens of connections just to the digital platform. It's a fun time to be here and to really try to serve the members better. But on top of that, there's exciting partnerships. There's exciting tools coming available that just make that integration a lot easier. I think that's the one other thing I'll add. But to Raj's point, it's definitely not easy. But we're on the right path to improve that and to make it easier all around.
Yeah, and I just want to add one more point to what Bill just talked about. Another complexity of integrations. I mean, I'm sure Torqueto can second that as well. Is okay. Let's say I have a core system. I have 30 or 40 fintech integrations. I already talked about the consistent look and feel and experience being a challenge. And the way you integrate would be a challenge. Some do APIs, some don't do APIs, some do SSO, some don't, right? So in any case, now think about the customer experience. That journey itself is inconsistent. But now on top of that, as a credit union, if you want to monetize all of that data from all of these different systems, think about it. None of these integrations talk to each other because they're all discrete integrations. Now, as a credit union, if I want to monetize all of this data from all of these different fintechs, guess what? I need to figure out how to aggregate all that information. And how do I create a data exchange between fintechs? If one fintech needs to share data with another, how do we do that? So there's a higher level of complexity that gets introduced into this whole mix.
I love that. And I think that is a great, great kind of takeaway. And also, Raj, we need to invite you back to an open finance ecosystem webinar so we can talk about that data. I think that would be a great, great follow-up.
Okay.
All right. One thing, and Torqueto, you mentioned it, I'm going to kind of move a little away from integration and focus on the next gen member strategies. And Torqueto, you mentioned next generation banking, right? And McKinsey, over the last couple of years, came out with an interesting point that credit unions face challenges in attracting younger people. And part of that is the aging of the boomers and the current members, and then we've got these digital natives, the digital borns that are expecting way different experiences than what I do. So I want to talk a little bit, and Bill, I'm going to come to you. When we think about creativity and we think about next gen members, I know you're working with credit unions on youth banking initiatives. Can you tell us about that and how can that really meet these digital borns where they are and draw their families in?
Thanks, Lisa. That at Kachinga, that's really our ultimate goal, is to serve you're really that future generation of members through financial education. One of the things that I'd like to start with as we look at this, we need to look first at some of the data and some of the numbers. So today, what I've heard is that we see over 94% of the US population is considered banked. The gap of that unbanked typically includes both that older and younger generation, along with, outliers where maybe low to moderate income households. But we do understand that there are the needs to serve the youth. The other interesting data point before I talk a little bit further about this is we've heard that there are surveys saying that 65% of American adults really don't have the desire to change bank accounts. And so with that in mind and looking at the large population being already banked, it really becomes a challenge to think through what are the costs associated with acquiring those new members. And so one of the things that we'd like to encourage the credit unions that we talk to is to really look within. Today, when we talk to credit unions, we hear that 3 to 8% of those accounts typically are child or youth accounts. That's quite different than the numbers we see across the country, where 39% of the kids have savings accounts. And so there's definitely opportunity to expand just within the credit union's own footprint. And I realize we talk about the aging member, but we still believe that there's a significant opportunity to look within. And that's just talking about the opportunity for youth and the future of lifetime members. But on top of that, that creates a little bit more stickiness with existing members, right? So if there's a member who's an adult with a family and they're using some type of program for their youth, there's also opportunity for them to start using the credit union as their financial institution of choice. And so I think that's kind of a twofold opportunity. And then back to Raj's points earlier as well. I mean, there's other products that the existing members need. It's not just youth accounts, but it's a wide variety of technology needs that serve that next generation of member, and then also help improve overall technology and efficiency.
Raj and Sue, any comments about youth banking and the opportunity there?
Yeah, so I can take this. So Bill was right? So there is a gap in youth banking. So if you look at generational banking as a whole, all the way from, if you look at all the products and services, a lot of the credit unions and banks offer, a lot of them are pretty much commodities at this point, right? And if you do some introspection, you'll know that there are gaps in products and service. Every institution is different, but for the most part, you see that there is a gap when it comes to youth banking, and people are beginning to also start talking and addressing the wealth transfer, right? So there's an impending wealth transfer. So I'm assuming a lot of that wealth is going to end up in some of these youth accounts, right? Or millennial accounts, or other accounts. But there is an impending wealth transfer. And on the flip side, on the other spectrum of youth accounts, is the older generation who are preparing to retire, and with trusts and retirement assistance, long-term medical. There are so many other products and services that, for the most part, as a credit union or a bank, we don't offer them. Right? Maybe some do, but for the most part, there are gaps. Like youth banking is a gap. The other end of this generational banking, there are gaps. So there are opportunities for credit union and banks to venture into new areas and create new revenue streams. Having said that, on the youth banking side, there is a statistic that's, I think, I've heard it multiple times, that almost 65 to 75% of the American population is financially illiterate, right? So the idea of youth banking is so critical, because the kids, including my own daughter, who have graduated high schools and colleges, and they're also working, have very little financial literacy they have very little financial literacy. So they're still, the parents still have to help them with all of their banking needs. So what that tells me is that they're not getting adequately trained in high schools and colleges. But what I heard from my daughter is firsthand that financial literacy is critical. Yeah, I went through all the classes. None of that stuck. However, it's not contextual. Mm-hmm. So they want to learn about it when they need it. So that was my takeaway around financial literacy when I was talking to my daughter, right? Yeah. So the fintech products that focus on financial literacy need to make that more contextual.
So I want to add, because I think that you're both on some very interesting, trains of thought. One is, I think that it's a misnomer to think that 3 to 8% of the current members are youth accounts, because if 39% of them have savings, somebody's in there establishing those relationships. And so the whole idea of the family, the parent, pardon the term, but cradle to grave is kind of the raw term that I would use in Raj's example. And I want to quote a case study. I live in Boulder City, Nevada, 15,000 controlled growth, right outside of Las Vegas, which has no growth. I mean, unlimited growth. So we're in an environment that we want to sustain the youth. So about 20 years ago, Boulder Dam Credit Union, which is now a, close to $1 billion credit union, with those 15,000, limit, it's got 30,000 members. But they implemented a program where they do financial education. Brandy Stankovic runs that program, and they pay their juniors $50 and they pay their seniors $100 to attend financial certification. And so they get it twice, and then they have to have their parents sign off, and then they go back to the credit union and deposit the money there. The reason I bring that up is they have close to a 95% plus retention of members. They get their first car loan. They do exactly. But we're looking at a strategy. And I guess what I would say on all of this is that the one-offs, let's do a youth program. Okay, that's costly, so we won't put a lot into that because we really aren't going to generate any income from that. Well, I think that if we get the parents involved, and I'll jump to the other side, we are having if you will, the ancillary conversations about where's the money going to go on these wealth transfers. It may be going to children, but it also is frankly going to be something that the children look at and say, what? You had $1 million sitting in a savings account, right? So you making the point that it has to be all the way through the generations, both of you, and making more out of a youth account. It's not just, let me set up an account for kid, let me set up that. It's about making them work for money, understanding the practicality, the application. And one thing we're seeing from a trend in the US is more hands-on learning, right?
Yeah.
So I'm not passionate.
And I love that we deep dived on this. This could also be a follow-on webinar on youth banking. So maybe we ought to put that as a potential topic. But I think it's a great example of fintech innovation, right? And there's a lot of other great ones out there enabling things like pay by bank or even peer-to-peer lending, right? That just starts to change the game for our credit unions. What are the biggest challenges enabling them? We've heard a little bit around integration, but what are the blockers? And Raj, you, Torquato, Bill, I'd love to hear what you're seeing out there that's really stopping our credit unions from embracing these innovations.
Well, I mean, nothing is stopping us from doing it, right? If you have deep pockets and if you have the talent and the strategy and the vision and the wherewithal and the leadership, you can do it, but it's a balancing act, right? Especially when you're working with constrained budgets. So having said that, so you're trying to balance multiple generations, right? It's not like you can say, you know what, I'm going to shut down the call center because everybody is, most youngsters are using their mobile app. No, you can't. You still have a segment of population calling the call centers on a regular basis. So you keep adding channels. We've kept adding channels over the years, but nothing has gone away. So we have created a technology complexity because you are servicing multiple generation of members. And the complexity with each generation is, different, but at the same time, you're trying to provide all of these products and services in a consistent fashion across all generations.
That's a big job.
And their needs are different, right? Their behaviors are different across each channel. So you're trying to balance all this and trying to find the right fintech partner at a price point that's amenable, right? So having said that, we already talked about the legacy issue. We talked about integration challenges and all of that, right? So that's not going away anytime soon. But as a credit union, now the challenge is, all right, so we do all of these integrations. And over time, you have a sprawl of integrations. I may have added, one vendor for something that made sense 10 years ago. Then I add another vendor for something else, right? But down the road, now these two vendors probably enhance their product offering. Now I have duplication and overlap. So which vendor do I keep? How do I do that consolidation, and who do I get rid of? The contracts with all these fintech vendors, that's another challenge, right? So I just gave an example. We have 40 integrations That means that's almost 30 or 40 different vendors in some cases. All of these contracts are probably starting and ending at different times because they got added at different times. Right? So just the sheer magnitude of managing the contracts and their expiration and when to get rid of somebody, when you cannot get rid of somebody, how to consolidate, all of this is challenging. And then with the fintech vendors, some of them get acquired and then they get sunset. There's another challenge. And then some fintechs don't have integrations with the core systems. Okay, the popular core systems, yeah, DNA, Scimitar, Correlation, yeah, most of them have integrations. But I'm sure there are hundreds of credit unions on XP2 and some other archaic core system like Spectrum, right? They will have a very hard time with some of these fintech integrations. So there are plenty of challenges, but again, it needs a very methodical thought process on a strategy, like Sue said, on how to get through this challenge.
Thank you for
And what you
walking
do in
us
your
through that. I'm feeling your pain right now and everybody else's. Torqueto, anything to add into that?
Basically. So Raj touched a very key point, which is technology is not easy, right? Somebody says, oh, add technology on top and everybody is going to be happy. In fact, more technology you add, more complexity you have.
Yeah.
And to Susan's point, at some time, legacy needs to go away, right? So this balance is extremely hard, and this is the key, right? And there is no right or wrong depending on our size, depending on our customers, depending on everything. And to Raj's point, credit unions, they are dealing with multiple generations, and those generations understand experience and convenience in different ways.
Yeah.
So for you, a call for the call center with somebody telling you something is more comfortable than an app. That's different, right? But channels, channels are channels. And more channels, more complexity to Raj's point. And we need, as a technology provider, we need to help customers and credit unions in special to find this balance and to analyze what they have in terms of integrations. Because what I said at the beginning, integrations are kind of, yeah, it's just integrations. I'm moving to the cloud and this is going to be solved. It's not like that, right? Integrations are key, and 2 points. Integrations can generate you new channels that can be better, or they can turn up into a nightmare to manage. And they can leverage you data to do something, new revenue streams. They can do the magic of data that we all know. Although there's the other side of the coin, which is can turn your complexity into a very big nightmare and keep you up at night. So build your integrations and establish those partnerships in a way that you see exactly what you're doing to the end customer, because everything is under convenience and experience. Know the customer first. See what kind of experience that you must have. And after that, see internally what you can turn off in terms of legacy as well. It's not easy. I'm not saying that it's easy. Like we know Raj is saying in practice. So yes, I need to maintain those channels. Although to Sue's point, and sometime legacy needs to go away. So integrations and a solid build over it can tell you in a data-driven way when, right? So this is the key part of it.
Hey,
So
Lisa,
I'm
if
going
I
to
could,
ask.
could
Oh,
I
yes,
just,
go
yeah,
ahead,
I
Bill.
just love to add just kind of one more thought here. I know we've spent a lot of time about technology, speaking about that, but Raj started to kind of open the door a little bit farther beyond that, right? And I think that there are other things just to highlight. Technology, of course, that's the biggest challenge we think about, the most money spent there, but the complexity also lies with vendor management, compliance, our own management within the credit union. Do we have the right resources to support change? So it transcends really across the whole organization. And as we talk about challenges, we definitely want to just keep those in mind too, that it's not just that tech piece, right? It's much bigger than that. And hence why sometimes technology takes so long to change, right? It's not just that the technology couldn't change, it's that there's a lot of other pieces in the mix.
Yeah.
Yep.
And I just want to add one more piece, is before I forget, is integrations. All these integrations are also causing cybersecurity challenges. Let's not forget
Yep.
that,
Yep.
right?
Yep.
That's another huge challenge.
That's a drop the mic add in, Raj.
And I'll add one statement to that. And then the other thing is, I'm going to retire before we ever do any of those conversions. So, I mean, we've got some real, as Bill said, people sides of this as well. So,
Yeah. And across the board, and I'm hearing it's also that zoom out and a mindset, and really putting the collaboration back into the cooperative model when it comes to all of these ecosystem plays. I want to ask two final questions. The next to the last one is about this CUSS. And Noah, you're not going to hear profanity spilling out of my mouth yet. Uh, I'm hoping that stays at bay here on our webinar, but there is a credit union shared service model initiative that Sue is leading that is really looking at how to deliver to the credit union space the collaborative partnerships that understand the credit union world and can be more affordable, less complex. That doesn't mean they're simple, but Sue, can you tell us a little bit about that? And then I believe there's an event in DC where you're going to be talking a lot more depth about this.
yeah, let me start with the concept of what is an underground. An underground is an event that we put together where we identify issues within the credit union movement and opportunities, and we say, what solutions can we bring forward? So we call it, ideas in action. And so collaboration was the focus last year at our underground in Washington, D.C. And out of that came a working group that said, we have to get back to our grassroots. We have to cooperate with each other. The credit union movement developed an ecosystem around credit unions that was very effective early in their life cycle, where they did issues around ATMs and indirect lending and card services and so on. Those are now legacy systems, and we don't see that same collaborative new innovation happening. So credit union shared services, we call it CUSS, just to have fun, makes us like, what do you want to cuss about? What do you think are critical issues? And so some of our topics that we're going to hit on, we're going to ask the CEOs what they're seeing in the world. And frankly, there's a lot to both positively and negatively cuss about. Then there's also the whole idea of fractional leaders. We're not going to have a $10 million credit union be able to find a new CEO. So we got to share them. And then we look at the whole concept of back office. I firmly believe that we should have a holding company of back office functionality. And then the last has to do with CEOs are retiring. They've dedicated 40 years of their life to this industry, many of them women, and they have no retirement. And I think shame on us. We have to look at that. So credit union shared services is the idea of this four-legged stool, if you will, to be able to work together through an infrastructure. And Ryan Stankovic on our team is working with Turketo and others to be able to deliver scale and to put Kachinga and the youth programs and our other partners into a model where we can drive down cost by driving up scale. And that's going to take a mindset shift. We know that this is not an easy event. So on March 2nd, the Underground, Washington, D.C., will be sending out information. We'd love to have you there. Immediately following the Underground, we are going to do a CUSS showcase where we're actually going to show case studies that are being implemented. So we're exciting, and frankly, we're going to be custom. I mean, you know, it'll be an opportunity for people to get together, a few hundred folks at the executive level.
Thank you. And we'll make sure there's a link to that registration at the end of this webinar.
Thanks.
And we're excited to support this initiative and help fuel even more growth in the credit union movement. With that, I'd like to come to the final question. This is our lightning round. This is my favorite part usually because for our audience, it's about giving them one key piece of advice from our expert panelists. So I'm going to come around the horn and I'm going to start, Raj, with you. What is your one piece of advice to our viewers?
Well, Sue kind of, I think, mentioned it early on, is, I've always been an execution guy. So get shit done is always been my motto. But what I've seen I've been around the credit unions for 12, 13 years now. So what I've observed is too much reliance on vendors to get stuff done for them. And when things fail, they fail because a lot of the credit unions do not have skin in the game through some of these projects. They just rely on vendors all the time. So you need to develop that internal talent and internal skill where you're in the driving seat, working with the fintechs and all the integrations, so your projects go smoother and successful. So you just can't rely on a vendor to do everything for you.
Love it. Take ownership, take control.
Yep.
Bill.
Yeah, I'll try to keep it simple. I'd say, an important takeaway would be to listen to your members and understand really what they need, but also listen to what maybe they aren't saying, right? Listen to what the other generations need. It could be the younger generation, it could be the older generation, but those are your potential members, right? So, and then, continue to look and see what products are out there that support those member needs.
Member centricity. Love it. Sue.
Yeah, and I'll focus on the fact that the train has already left the station. We have AI solutions out there. We have open finance solutions out there. People are integrating, implementing the next generation. Frankly, I don't want to call a call center. I want to use technology. So it's not necessarily just generational specific. It's time for us to be forward thinking, and we have to, if we're gonna move things forward, it has to be at the board level, all the way through the executive level, and a complete understanding that we have to move. If there's, if there's a major takeaway of what's happening in our U.S. finance world right now, is every day things will change, and the train is moving forward, folks. So now is the time. It's a critical time for us to step in and, frankly, take control to the extent we can of our vendor relationships, our people relationships, and let's make sure credit unions are relevant. There's a very important purpose for them.
Absolutely. And now let's hear from Felipe Torquedo. What's your advice?
I'm going to align a little bit over Sue and Raj, but take a different route. So credit unions have a lot of data, right? So own your data, understand the membership perspective, and do everything in a conscious way. In this way, I think credit unions can overpass this legacy, not a problem, but this legacy situation and thrive, because this community sense only credit unions have. So they have gold, essentially.
Excellent. So the key takeaways from our expert panelists: take control, drive member centricity, the time is now, and don't forget to own your own data. I think that summarizes an amazing hour together. I want to thank each of you for taking time out. I know you've taken time away from members, from clients and your own lives. So thank you. To our audience, a big thank you to you as well. And what you'll see here on the screen are the LinkedIn profiles for our experts so you can connect and keep your own conversation going with them. And additionally, information on the underground, CUSS. I know Torqueto and I will be there. We hope to see you there. Let's CUSS together. And finally, thank you for the time. We'll see you on the next Sensedia Talks. Until then, be well.